I want to bring in Michael Shaoul now. He joins us. He's the chairman of Marketfield Asset Management. Marketfield's flagship fund outperformed 91% last year, and he oversees $1 billion in assets. Michael, great to have you back on the program.
Thank you.
John and, of course, Dominic joining us as well. Let me just get your reaction first to these headlines. The IEA would be releasing stockpiles now.
I think it's unfortunate timing for the oil market, which already looked weak. I mean, crude oil before this announcement was already down $20 from its May peak. It had all the signs of a crowded trade, which was unwinding. We're coming into the end of the quarter. I think the last thing you would want to see if you were long crude oil is news that there's a lot more physical supply coming on the market.
Can I take the reverse side of that? I mean, for them to come out with a surprise announcement, you know, from some who I've spoken to this morning say, look, there must be a concern about a shortage here. Obviously, they're talking specifically about Libya and the concerns there, but that could arguably be a bullish sign for oil too, could it not?
It could, if the price was really being set in the physical marketplace. You know, it's our belief that you ran up when Libya first had its problems from 95 to 115 without anybody thinking about it. You had already priced in significant supply disruptions. They haven't happened. And now all anybody knows is that crude is down 25 bucks and counting, and there's more physical oil coming on.
Well, it's not just that, guys. Remember, Fadel Gate over at Oppenheimer told us not too long ago that he thinks the fair price of oil should be about $85 in the mid-80s, and that speculation really is driving a lot of the price. So, Michael, how much of this is really just, like you said, an unwind of a trade, speculators getting out of the market and getting more to the fundamentals of that physical oil market trade?
Yeah, I mean, I think crude oil looked very, very comfortable between $65 and $85 for about 2 years before, first quarter of 2011. And I think if it went back there, it would be great news for everybody, apart from those who bought it when it was 115. So
that would be bullish for stocks then, if we did see that happen?
Yeah, it would be helpful for corporate earnings.
But doesn't this, helpful for corporate earnings, obviously, for their margins, but doesn't this tell you that there's this great disconnect, right? Yesterday you had Ben Bernanke talking about how he's not quite sure what's going on here in the U.S. economy, right? So we're looking at lower demand. And then you've got the IEA now coming out and releasing stockpiles. So you're getting two different signals coming out.
Well, yeah, but they're talking about two different kinds of demand. I don't think Ben Bernanke was talking about physical demand for crude oil yesterday.
No, but he's talking about a slowdown in growth.
I think the most honest thing he said is he doesn't really know what's going on. I don't think he does know what's going on. I think there's a lot of confusion, a lot of frustration, I think, at the Fed at the time it's taken for the U.S. economy to really get going. But if they went back and did their history, this is still a very, very normal recovery from the sort of collapse that we had in 2008.
So, Michael, when you look at the world and try to figure out investments right now, let's not forget the IEA is based in Paris. Earlier this week, the focus was all on Greece. For those types of economies to recover right now, for the governments to be able to pay their bill, obviously a lower price of oil can be helpful in that process. But do you look at the U.S. and say, I like that market? Do you look at Europe? I like that. Where are you looking?
We look at the U.S. and we say, yes, we think the domestic economy is still in the middle of what should be a multi-year expansion. We look at emerging markets and we say, these are markets which are probably at the end of a 10-year bull run and really could be unwinding at the moment.
And you say we're in the middle of a bull run here in the U.S., right?
Yeah, I think so.
And the data to you shows what? That the worst is peaking or what?
The data shows that economic data is extremely volatile. I think we'll look at this quarter's earnings season very carefully, but I would expect this quarter's earnings season should demonstrate that momentum is still intact for corporate earnings, and that's ultimately what you care about when you own equities.
Really quickly here, what's the best idea out there right now? Besides just the U.S., is there a sector, something in particular that you think?
I mean, I have a hunch that the media sector is going to be a very exciting place to be over the next couple of years. I could see content being completely revalued by the marketplace. That seems to me to be something which really, over the next couple of years could be a very exciting place to be.
Could be worth buying. Interesting.
Absolutely.
All right, Michael, good to have you back.